what I understand is that the demand from China suddenly has made a comeback. So globally, you've seen a rally in the Alcobas and the BHP Biltons of the world. And why is China suddenly consuming? Are the Chinese again stocking up, or is China telling you that look, the coronavirus impact is behind them and they've normalized, and they are the ones who are going to be building back again? And if they do so, then we are looking at a very different kind of a demand. We'll try and get some reactions from metal companies going forward, but my understanding is that steel prices have gone higher, both HR and CR. B, you definitely have an edge for steel companies which are exporting, because if China demand comes out, exporting is going to increase. So I will not be surprised that the recent momentum which is there in steel stocks is going to be here. Within the ferrous space, there is Hindalco. Hindalco has got global and local businesses, so it's a complicated one to understand. Vedanta has got this whole issue of delisting with LIC, and that's one stock which eventually will get delisted. So you know that if you're a long-haul investor, you cannot invest freely and fully into Vedanta. So you're not left with too many, frankly, options within the banking, within the metal space. Hindustan Zinc, completely dependent on zinc prices, which follows a different trend. That's the challenge for metal. A JSPL, we talk about pharma, but let's look at where JSPL was. Let's look at March and today. JSPL came crashing down to almost 60 rupees, and from 60 rupees, JSPL is now nearing 200 rupees. So there has been a very strong comeback in metals. While we've spent disproportionate amount of time discussing Reliance as a stock and pharma as a sector, metal is something which is still considered to be risky, and you don't want to buy metal stocks when the growth is low. But the bottom line here is, look at JSPL. Look at the March graphic of JSPL. From March, which was 60 rupees, it is at 200. So it's 300x. 3x for a stock like JSPL. Atul Suri, good morning. Thank you for joining us. We've spent disproportionate amount of time to discuss Reliance as a stock and pharma as a sector. But look at metals. A stock like JSPL has gone from 60 rupees to 205 rupees.
Yeah, that's very interesting, because what you are seeing in this pullback rally post-March is that there is a very good, broadening of market. So if you had Reliance that dominated 1 month, you had IT that dominated another month, you had pharma that dominated another month, and now it is metals. So the thing that is happening is that the market is not being just driven by one engine. Yes, the perception is that pharma is the one that is leading. For sure, it still is leading. But the important part is that when something cools off, something else takes over. So it's like a relay race where the baton is being passed and not one runner is running the complete 400 meters because he will tire out. And on the flip side, the burden that they are carrying is the burden of the Bank Nifty, because the Bank Nifty is still the largest part of your indexes, whether it's frontline or mid caps or whatever. And there's a massive underperformance that is happening there. So that is being offset. So as I said, that today maybe it is metals, it was IT a month ago, sometimes it was Reliance. So the passing of the baton is very important for the broadening of the market. And that is visible in the market breadth, because what you will notice in this complete rally is that the market breadth has been awesome. And it is this broadening of market breadth which ultimately is a very good measure of a market base or a larger bottoming formation, which we have had. And it's not just a case of a few frontline index stocks, or it's not a bottoming of just the index. It is the bottoming of the market, broadening of the market. And that's where your whole metal place comes in. Again, all the sectors that you see that are doing very well the last 3 to 4 months were under-owned sectors. Even pharma prior to COVID was under-owned. It was a sector that did nothing for 5 years. Everyone was underweight pharma. IT, at best, most people were equal to underweight. Reliance, metals, it's still, even as of right now, it's massively under-owned. So what you are having is a very big pullback rally. And the broadening is what is really good for the market. It's heartening for the market, because that's where it really puts in a solid base.
Let's spend some more time on metals, Atul. Could metals do what, let's say, pharma has done for us, or what IT has done for us? The juicy trade for the month of July was IT. If you bought into IT stocks in the month of July, the index gave you a 20% surge. If markets are rotating so much, and if all sectors are moving in tandem with each other, with the exception of Bank Nifty, does the puck now stop at metals?
So metals are very, very interesting because see what happens is that if you look at the genesis of the complete rally that you're seeing in the global, whether it's equities, commodities, etc., you know that there is a massive liquidity infusion. And one of the best measures of seeing how global flows are is the way the dollar is reacting. So what you have is a very sharply weakening dollar, and that results in money moving to a risk-on phase. Equities is one, and you're having a phenomenal equity bull market, and that is global in nature, irrespective of what a country is doing or not doing in terms of COVID, how well or badly they are controlling it. The money is flowing in, and everyone is getting a little bit of the hooch. The fact is that this ultimately also moves to metals. Yes, we may talk about China demand, etc. But what will happen is that what you are seeing is a massive flow to a risk-on trade. And that is why you will find that what we saw in gold and silver, maybe again, you are going and seeing this in industrial metals. So if you look at the base metal price movements, whether it's copper, zinc, aluminium, you realize that these also have been multi-year underperformers and they are really coming out of it. So yes, you may have a trade, but again, I would like to use the term trade and not a trend change. See, in this time, when things are all going up, everyone's enjoying the party. You will have to differentiate between those sectors which are trades and those sectors which are a massive shift that has happened. So for that, let us look at our earnings. So we are in the result season, and I think by this week we will finish. You will notice that the number of companies, I know times are different, it's COVID times, but the numbers of companies that are still reporting top line and bottom line growth in these difficult times, just a handful. And when you start looking at the disbursement of these companies, you realize that they fall into the quadrant of essentially it is dominated by pharma and it is visible. Second is specialty chemicals. Specialty chemicals is the longest running bull market we've had in recent times. They really never stopped. They were doing well before COVID. They're doing well post-COVID. The third is a new theme which is working out is agri. Again, you're seeing very good numbers come out here. And fourth is IT. So for me personally as a portfolio manager, yes, that there is momentum, but you just cannot chase momentum because if the market's correct, which they will, you realize that damages also happened max here. So you have to be very fast. So I think that structurally the four themes that I would look to be invested in, as I said, not a trade, but as an investment is that pharma, because you can see the kind of numbers that are coming out. And what is happening is a massive, it's a strategic shift that is happening in this sector. And this trend can last the next 3 to 5 years. Specialty chemicals, as I said, they were doing great. They continue to do great. Agri is a new theme. I think that some of the numbers being posted by some of these companies are fantastic. And if this plays out, this can be, again, an under-owned, underloved sector, which can be a longer kind of move. And IT. I think IT index at lifetime highs, not only are the few large caps, but some of the mid caps are an absolute fire. And what is happening is in all these four things, they are being backed by numbers. It's not just liquidity. And it's not just momentum. So the important thing, and I know that a lot of retail is in the market, so I'm really addressing that learn to bifurcate between a trade. Metals can be a very good trade, I'll tell you, and it could be the trade of the month. But you have to ultimately look at companies that are delivering numbers in difficult times. Because ultimately, if you are able to perform in these times, what it will signify or what it shows is that there is a massive tectonic trend that is happening there. And that is something where I limit myself to those four things.
Sure. Atul, morning. Where does banks or financials as a sector with its largest weightage actually come in over here? Because irrespective of the spree of fundraising, and mind you, very successful one at that, bank stocks haven't done anything. ICICI Bank continues to struggle at that 370, 360 odd zone. HDFC Bank unable to successfully cross above its 200 DMA as well. When do you think this spree of underperformance is going to change?
So definitely, as I pointed out earlier, that the baggage or the burden on this index or the market is the bank nifty. See, from the bottom, the nifty has gone up 50%. From 7,500, you add another 3,750 points, you'll get somewhere to where we are. But something like the pharma index has doubled, right? IT is up 70%. Reliance is up more than 100%. So these are the positives. Now, to offset all that, you'll find that the bank nifty from its base is up only 36%. So the underperformance of banking is very, very stark. Now, people say it's an important sector. We do understand that it's difficult to have a very elongated or a bigger bull market without banks. But I personally think that these are going through consolidation. And I feel that when I look at the numbers, I look at the commentary, that there is still no clarity as to how big is going to be the hangover of COVID. And there are a lot of accounting stuff that is happening. There is a lot of government policy that is masking things in the short term. It's still that this whole thing is not open. The confidence will not come. There could be two things. One is that it could surprise us that realize that things are not as good or things are actually quite bad. Or the fact is that we are getting overly bearish or we were overly concerned and things were not so bad. So the thing is that the banks will get re-rated, but it will be dependent upon when we get a clearer picture as to what is really happening in terms of numbers and all these moratoriums, etc. And I think that is when you'll get clarity, and that's when banks can be re-rated upwards. But at the moment, the market is not looking very confident. That is why you'll find that the bank nifty is underperforming. Banks can do a very good catch-up trade then if things are positive. If not, I think that's what the market is pricing in, that things may not be as pretty as it kind of seems and thereabouts. So I think banks will go in for some bit of consolidation. They will take time. But as I said, it's fine. It's really fine for the broader market if the largest index doesn't, because this index outperformed for 4 to 5 years prior to that. Everyone is over-owned, or that is where the biggest allocations are. So it is very typical or nature of markets or behavior of markets to actually start looking at areas which are under-owned, underperformed. And that is what I pointed out earlier, that the sectors that are leading this, those 4 themes that are leading this, were actually among the under-owned areas. And that is where the surprises are. So markets is about surprises and also places where people have under ownership. And that's what's being reflected globally. This whole small and mid-cap rally is happening globally. The market is surprising everybody. Everyone said that post-COVID, the small guys are going to get wiped out, the big are going to get bigger. But what has really happened is that the small and mid-caps, and it's not just India, it's globally. You will find that the small and mid-caps have done much, much better than the large caps, who were logically supposed to be the biggest beneficiaries or where increasing market share is. So markets tend to surprise, markets tend to like or rally in places where people are not there. And the case in point is metals today, pharma last month, IT before that, and small and mid caps, as the indexes, Nifty is up 50%, the small cap index is up 70% from the base. So that really puts the point out that what is the amount of ferociousness that is there in the small and mid cap space. And as I said, it is not just India. You can look at the US also, and you'll find that that's the trend that's playing out there. So we are having a very big under-owned, oversold kind of rally, and that is global in nature.
Sure. All right. Atul, while it's good to see the breath catching up, I just want to touch upon some of the trends where, as you mentioned as well, we've seen a huge rally this year so far. Would there be any pockets where you'd look to book profits, even if it was partially? I know that some of the stocks, the saying goes, if there's nothing wrong, why fix it? But just given the kind of steam that we've seen in this rally, does it make sense to perhaps look at shaving a little bit off when it comes to the profits?
Depends whether you're a trader or as an investor. See, as a trader, and there are a lot of first-time traders that are in the market, that's expressed in the kind of numbers broking firms are reporting and the kind of new accounts that are being opened. So I guess for them, the discipline of stop loss, that's written in stone. There has never been and never will be a compromise with that principle. But for me, who is a long-term trend investor, for me, what really matters is ultimately, yes, the market is on fire, but are they backed by numbers? And as I said that, we use our own proprietary filters, and the universe of companies that even in these times reporting positive growth, top line, bottom line, and other parameters is just a handful. There are just about 50 that actually fall into my filter, 40 to 50 stocks. And those are dominated by the four themes that there are. So I personally think that the market will correct. It should correct because things just can't go up vertically and cannot be so easy. But the important thing is that you have to avoid those areas which are just momentum trades and focus on those companies, those themes which are backed by numbers. Because I personally think that these companies or these sectors that are reporting good performance, even in these difficult times, it's not just one-off. There is an underlying business shift that is happening. There is the start of a mega trend. And ultimately, I would use the correction to actually deploy money in that. So I'm very careful. Yes, we all like momentum. I mean, I like momentum. Definitely, that's one of my briefs. But the fact is that you have to be selective and not compromise on quality and not compromise on earnings. Because when the market corrects, these areas will hold out. You will find buyers at lower levels. If you are just chasing something where it's not backed by numbers, you will find that the correction tends to be sharp. So one has to, as I said very early, bifurcate between momentum, the trade side, and I think investments point of view. So I am overweight the four themes that I mentioned: pharma, specialty chemicals, the agri theme, IT. And this is the reason for that, as I said earlier, is backed by companies delivering numbers in different terms.
Great. Talking about IT as well, when we take a look at specific stocks, of course, there's a little bit of divergence on performance in the last few months as well, apart from the overall theme. Do you feel that we'll continue to build momentum in IT? I know you're bullish on it, but just trying to get deeper into your rationale, because perhaps have we topped out for the moment, or do you actually see a consistent build-up that we'll possibly see there, particularly as things continue to improve?
But the first sector index to break into lifetime highs was IT, and it still does. Most of these others are playing catch up. Even pharma is not at lifetime highs. It's just doing a catch up of multi-year underperformance. So you have to respect the first sector that breaks out into lifetime highs, and that is IT. So IT actually never had it very bad either. So I think that a sector that breaks into lifetime highs and with many of the larger components leading, and the more interesting part of the very interesting hunting ground is what is happening in the mid-cap space. If you really pull those companies out, you realize that the numbers that have come have been very impressive, and that is also supported by momentum. So ultimately, the game is, as I play it, or as I understand, or that's my brief, is ultimately to look for companies that are quality and use momentum just to optimize your entry and exits. So IT is one such space which has broken out into lifetime highs. I don't think that it's going to end so soon. It will correct. The markets will correct for sure. And the correction will hit all these sectors and stocks for sure. But the important thing is that 2 to 3 years down the line, I feel that these sectors or themes will be far, far better wealth creations than looking for every week a new rotation, a new sector, a new stock. So, as I said, backed by fundamentals, backed by quality, backed by earnings. And yes, why would I like to refuse momentum? If it comes, it's always welcome.
Connect with the management of Cipla. My producer is just going to tell me at what time do we need to go to Cipla. It's almost 9:40 right now. Okay. Atul, what would be, let's say, what would be a very large, pharma is in a multi-year bull run. There is trend, there are trends, there is evidence, there is momentum, there is tailwind, and then there is opinion which is supporting pharma. But ultimately, it's about risk management, right? How deep would your stop losses be in pharma? 10% lower, 15% lower, or you would not have, stop losses at all for pharma?
Yeah, I don't. When I invest, it's not, stop losses are not, is not a way. I think when you invest, you have to look for two things. One is the change in the underlying earnings. Very often prices may correct, but that may be a function of markets or one-off. However, if the underlying fundamentals haven't changed, if the theme hasn't changed, you'll realize that you don't put those price targets or price stop losses. Let's take the case of specialty chemicals, right? They were doing very well pre-COVID, And when the market fell off, you'll realize that they also corrected. They corrected large, 20, 30%. But what happens is the moment markets stabilize, these quickly move towards lifetime highs. So what will happen is that when you are, and nothing changed in the fundamentals. In fact, I think in a lot of them, they have improved. The numbers have come better. So what happens is that if you put just price targets or price stop losses, if you are as an investor, then I think the market will shake you off. However, if you are as a trader, and that I think is very important for me to share with you, because a lot of new first-time investors have been in the market. And I have been in markets for many years, seen traders. The biggest problem, it's just not difficult what to buy. I mean, the screen is telling you, your friends are telling you, your WhatsApp groups are telling you. It's no rocket science what to buy. What's going to be important is when you sell. Whether you sell at a profit, at a certain target, or you put a stop loss. And the importance and the discipline of keeping these stop losses is very important, because that makes sure that you take some money home. And these stop losses, even mentally talking, whether it's 5 or 10% is very easy. To actually implement it is very difficult. I mean, there's a beautiful line by Mike Tyson, and one of my favorites, that everyone has a plan till you get punched in the face. Right? So that's what happens. So when markets correct, the discipline of sticking with your risk management is the single most important quality for survival and making wealth in this money. When the markets are going up, as I said, it's no rocket science. But when markets turn or correct, at that time to be able to bifurcate between a correction and change in trend is important. And at that stage, it is not your intellect, it is ultimately your discipline. So for a lot of people who, I know a lot of retailers in the market, they're trading and they're making good money, which is fantastic. But just make sure that when markets correct, please have the discipline of stop losses. If not, I have seen this story play out every few years for the last many years. The ending tends to be the same. In the end, it's your discipline that will actually help you make money.
It's a great point, Atul. So my last question is more like someone who understands trends and charts. When a bull market starts, and if indeed it is a bull market in pharma, it's going to be a multi-year phenomenon. Should one worry about 10-15%? Should one worry about a bad patch of 20%? Because even when a stock like Titan, when it was in a crazy bull run, it had corrected 3 times more than 30% and twice more than 50%, and yet it turned out to be the multi-bagger of the decade.
Absolutely. I mean, that's very true. So that is where, that is where a price stop loss for an investor or for a trend player is not the right way. What you will have to see is 2 things. One is a change in trend of the underlying earnings, the story. Is the whole business compromised? And this can happen. However bullish I am today, I have to realize that nothing is permanent in this market. You never know. I mean, what happened in 2015 was similar. Pharma was a crazy bull run from 9 to 15. And then you started having this US FDA issue and things went for a toss. Government policy, COVID. I mean, by now we have to all realize in our lives that how fickle and nothing is permanent. I mean, even like the great investors who hold for life, like we talk about Warren Buffett. I mean, look at the sales in airline stocks or whatever you have. So the importance of being able to be flexible, to change, and most importantly, is the discipline. So a 5%, 10% stop loss, as I said, depends on your strategy. But the discipline to be able to implement your strategy is the only single differentiator. I mean, this market is not represented about people with higher IQs making more money than people with low IQs. This market is a representation of people with higher discipline making more money than people with lower discipline. That's it.
Yeah, it's more critical not to lose money sometimes than to make money. But Atul, as always, great to have you on the show. Good chatting with you.